Most traders chase entries, they obsess over the perfect order block or the perfect fair value gap, and they're not asking the one question that matters, and that is, where is price trying to go? And that's what liquidity tells you, and that's what we're talking about in today's video. So I'm gonna explain what liquidity is, I'm gonna show you where to find it, and also how to use it to level up your trading. So my name is Justin Bennett, full-time trader and founder of Daily Price Action. As always, all of this is my opinion only and not financial advice. So let's talk today about what liquidity is, where to find it, how to use it to level up your trading. And not just level up your trading, but my promise to you is that by the time you finish this video, you're going to have a completely different outlook, not only on liquidity, what it is, where to find it, but also just markets in general, why they do what they do, and where they are trying to go at any given time. So first of all, let's talk about what liquidity is, then we'll talk about where to find it. So liquidity in the market is very simple. It's a very simple concept. So when you see on a daily time frame here on the euro, let's take a look at this here first, because it's very easy to see on a higher time frame. Whenever you get swing highs like this here, okay, or swing lows, right? These areas are where liquidity tends to build, because you get stop losses that build above the highs up here and below the lows. Because in order to push the market higher, you have buyers stepping in. Typically, they put their stops below the lows. Same thing back here. You have short stepping in. Typically, they will put their stop losses above the highs on the way down. Now, that's a very textbook explanation of what liquidity is. And ultimately, when you're thinking about SMC, smart money concepts, and whatever strategy you use, it's really not all that helpful. Okay, we all pretty much know that liquidity will build above highs and below lows, but how does that help us in our trading? And to be honest with you, it really doesn't. So I'm going to show you something here in a minute that is going to help you. Now, another form of it is equal highs and equal lows. So in other words, you get the market basically making lows like this here, okay, where you get the lows being equal. The market will often take these out and then continue in the opposite direction, okay? So this right here is the sweep of those equal lows. And you can get the same thing here with equal highs, where you get the market giving you equal highs, it sweeps those highs and then continues in that direction. Now, here's what I'm going to say about equal highs and equal lows, is that in my opinion, they don't really happen all that often. If you've spent any time trading the markets, you will find that equal highs and equal lows are pretty rare, okay? Now, when you get a market going sideways for a while, you will get equal highs and equal lows forming. But in terms of this video though, in terms of liquidity, if you understand that liquidity forms above highs like this and below lows like this, okay, then that also satisfies the idea that liquidity forms above equal highs and below equal lows as well. So let's talk now about where to find liquidity in the market. And I'm talking about the kind of liquidity that's going to help you with your trading immensely, okay? So first of all, I want you to start thinking about markets in terms of, if you'll remember, if for my millennial traders or even the older generations, right? That video game Pong, P-O-N-G. It was one of the first video games to be commercialized. And the idea was that you had this paddle that you moved back and forth and you tried to keep this ball in the air, right? You were playing against a computer and the ball would just ping pong back and forth, right? Hence the name Pong. So markets, guys, are very similar to that in that they will ping pong back and forth between liquidity. So whenever you're looking at a market, it's no longer just a matter of, random swings in the market, right? Every single move the market makes, yes, it will consolidate for a while, but when you get swings like this and swings like this up here, okay, all of this is for a reason, and it all comes back to liquidity, because liquidity is the lifeblood of any market. Now, before we get into talking about how to use it to your advantage, liquidity is simply resting orders in the market, okay? So in other words, liquidity is unfilled orders, period. That's it, very simple. So it comes in two forms. One, the one we already talked about, where you get stops that build above highs like this, you get stops that build below lows like this. Now, the other form of liquidity, and this is the one that in my opinion, SMC traders really don't give enough attention to, is going to be the orders that form on aggressive moves like this here, okay? So let's move in here and take a look at this Euro USD chart. Now, let's actually go back here too, because we actually have two aggressive moves that formed within this trough right here. The first one being this sell-off back here. So again, we know that stops build above highs like this and below lows like this, right? We know that. That's very, very simple. Now, orders also build though, or liquidity also builds, because remember, liquidity is just unfilled orders. That's it. It can be a stop loss above the highs, because anybody shorting here who has a stop loss up here, this is just a buy order to get them out of that short, okay? So it's an unfilled order. Now, that means that if you have a very sharp move like this as well, Okay, so you get the market giving you displacement like this here. You also have liquidity that builds along the way. Okay, so liquidity is no longer just, above highs and below lows and equal highs and equal lows. We're also talking about liquidity in terms of unfilled orders during very aggressive moves. So these are also very thinly traded areas. Okay, so this is a thinly traded area, and that the price moved through it very aggressively, very sharply, and it didn't stay here for very long. Now, this is a little bit more controversial. A lot of people think that this right here, something like this, like a fair value gap, for example, an inefficiency in the market, does not necessarily represent liquidity that the market is going to come back to and try to tag. However, I completely disagree with that, because here's what happens. If you're using a market order, let's say you have a smaller account, you have a $100 account, a $1,000 account, typically you're probably going to be using a market order because it doesn't really matter all that much. If you get a little bit of slippage or the spread widens during your entry, it's not going to really, matter that much. You're not going to lose that much money. However, if you are an institution and you have millions or tens of millions or hundreds of millions of dollars at your disposal, you're not going to be using a market order because of that slippage, because of that potential for a widening spread during news. So you are more than likely going to be using a limit order during stuff like this, okay? And when a market moves very aggressively like this, and you're using a limit order trying to chase this down, okay, the market is going to just completely pass by those orders. Because if you don't get filled up here, right, these traders that are using those limit orders, again, these are institutions or just large traders, right, they are not going to get completely filled on this move because of how aggressively price moves. So what happens is you get these limit orders that don't get filled up here. And again, these are very seasoned traders. They're large traders, they're institutions. They're not going to just chase this lower. They're not going to chase it all the way down here into this consolidation. They are going to leave these orders up here because they know that there's a good chance we come up here and revisit this. And furthermore, again, these traders are not going to chase. They are seasoned traders. They know that, if I didn't get filled up here, I'm going to leave this order up here and see if we come up here and fill this. So for that reason, because these are unfilled orders, this is also liquidity in the market. Again, it's no longer just about above the highs and below the lows. It's also about aggressive moves, very thinly traded areas in the market that are also going to be liquidity that you should be paying attention to. Okay, and just a quick point too, because the title of this video is buy side and sell side liquidity, whenever we're talking about buy side versus sell side, so let's say that this is the current price right here. So if you have area of liquidity up here, this is buy side, right? So this is buy side liquidity. If you have liquidity below the current price, then this is going to be sell side liquidity. And the way to remember this is that this up here is the buy side, right? If you were going to buy, the market would move higher. And if you were going to sell, the market would move lower. So sell side is below the current price and buy side is above the current price. Very, very easy to understand. Okay, so we know now that we have a different form of liquidity, right? It's not just about above the highs and below the lows. We've also got these very thinly traded areas where those limit orders tend to build up. They don't get filled and they remain there. Now, it is true that over time, okay, if it's been months have gone by and that area has not been filled, chances are a lot of those orders are not going to be there. But if it's only been a few days or even a couple weeks, a lot of those orders are going to remain. Now, there's also another form of liquidity that, again, a lot of SMC traders do not think about. In fact, most don't. And that is long upper and lower wicks. And in order to understand this, we have to think about what a long upper or lower wick represents. So really, when you look at this here on the daily, on the Euro USD, you can see this long upper wick up here. Okay, so you have this right here. This was the open, the close down here. We have the high up here. Now notice how long this upper wick is. Okay, so in cases like this here, this is also technically going to be an inefficiency in the market. Therefore, there's also going to be unfilled orders up here in this region. Now, why is that? Okay, let's take a look at this here. And again, a lot of people are going to disagree with this. However, once you understand what an upper or lower wick is on a higher time frame, it will all make sense. So if we go back to this candle here, this is the daily chart. Now, if we flip to something like a 1 hour chart, okay, let's look at this on the 1 hour. And what do you notice here? Okay, we have a fair value gap, a very obvious fair value gap in this area. We have a few, in fact. Okay, so all of this up here, right? All of this up here is a fair value gap. So really a long wick on a higher time frame is nothing more than an inefficiency or fair value gap on a lower time frame. That's why whenever you see on a higher time frame, whether it be the 4 hour time frame or the daily chart, whenever you see that, okay, that is going to be an inefficiency. Look at this on the 4-hour as well, right? Look at this move here. Again, this is that daily wick that we just looked at. Look at the 4-hour chart, right? This right here is an inefficiency. And so really this video, we're talking about two specific things. We're talking about, on the one hand, these very aggressive moves, okay, like these candles back here that have no retrace into them. And then you've also got things like this over here, like this upper wick here on the euro on the daily chart as well. This upper wick right here, which is also an inefficiency. And again, this upper wick is an inefficiency because if you move down to a lower time frame, you will find multiple fair value gaps. So these are also worth paying attention to, knowing that there are unfilled orders up here because, again, it's an aggressive move. It's an aggressive move lower. Not all of those orders were filled. It's the same exact case back here. Now, there is a third type of liquidity that builds in the market, and that is session specific, okay? So what I mean by that is, let's go to a 15-minute time frame, and I'm going to turn on this indicator here, which shows us the sessions. Okay, so this is going to show us what are called kill zones. It's basically the most liquid hours within each session, and we're going to turn this off here, go back to this current price. So what you'll notice here is that this yellow box is the Asia session. Okay, now Asia, with a pair like the Euro USD, you tend to get the market moving sideways during Asia. And what often happens is you get London opening and sweeping the low, okay? And then notice what happened. We rallied from there, okay? So what often happens, again, you have Asia session going sideways, you get the market taking that out and then selling off back here. Here's another great example. You can see where Asia went sideways, okay? So again, you have liquidity that builds up below the lows here in Asia. You get London opening, sweeping that low, and then taking off. Okay, now this isn't always the case. But just because Asia does tend to go sideways, especially like I said, with something like the euro, not as much with the Australian dollar or the New Zealand dollar, but with the euro, you do get a lot of sideways action during Asia, and that range tends to get swept before you get an extended move in the opposite direction. Now, the key here, and I've made videos on this before, how to trade this, but you would look for the sweep of this low here, and then you'd wait for the close above the highs. Okay, and once you get that close, then that's your extended move in the opposite direction. Okay, once you get this through here. So I've made videos on this before. That's not what this video is about. But I do want to show you that there is also session specific liquidity that forms that also attracts price. Okay. And the reason this happens is because, again, you have stops that build up down here. Okay. And those large traders need that liquidity. They need those orders in order to fill those larger orders in order to do this. Okay. So that's why this forms. So it's also something to pay attention to. If you're looking at specific sessions like Asia, keep in mind that you get liquidity forming on either sides of this. And oftentimes in London, that first move beyond the Asia range is going to be a simple liquidity sweep, and then you get the reversal. Okay, so that's the other kind of liquidity that can form here. And again, the concept is the same. The market is drawn to these areas. They act as magnets for the market. So when you ask, why did the market do this? Well, this is it right here. Okay, you had the Asia range, you had liquidity that built below the lows. The London session swept that, tapped into that liquidity. Larger buyers came out in force, used that liquidity to their advantage, and started to buy the euro up. Okay, so let's get now into how to use this with your trading and really become a better trader. And this is going to be specific to SMC, smart money concepts, although really it can apply to anything you do. If you're a pattern trader, it can also work for that. Now, before we get into that though, if you do want to see exactly how I trade SMC full time, check out the link right here on the screen. That is going to be a free SMC strategy that shows you exactly how I trade full time. It's 2 hours of content that you will not find on YouTube. And if you want to join us in Discord for my help every day with your trading, you will have the opportunity to do that beyond that link. So first, sign up to the free course. Second, you will see the offer to join Discord. That's going to be my help with your trading. You're also going to get access to the trade journal. You're going to see my trades live in real time. And you're also going to get access to the full course, which is over 20 videos that I put together. Okay, so let's talk about how to use this to your advantage, right? How do we level up our trading and really look at the markets differently now that we know what liquidity is, where it forms, and how to identify it? So like I mentioned before, I want you to start thinking about markets in terms of, why is a market doing something, right? Where is it trying to go? And for that, looking at the euro back here, okay, we had this move lower. Now, if I play this forward, you'll notice that this is that inefficiency that formed. Now, I don't want you guys to get so hung up on a fair value gap. So you can see back here, we had this very aggressive move lower. Okay. And so at this point, once the market taps down here into these lows, okay, the very first thing that we need to understand is that we have this inefficiency up here. In other words, we have buy side liquidity hanging out up here in this area. Okay, because again, what tends to happen is you get large sellers coming out, trying to sell, trying to use those limit orders. The market moves so aggressively lower that all of those weren't able to fill. And so you have resting orders, unfilled orders sitting up here in this area. And that is literally the definition of liquidity and why it matters for markets. And markets, again, tend to ping pong back and forth between areas of liquidity. They act as magnets for a market. So the moment that we see the euro come back here into these lows, okay, what we're looking at is this area up here. Now, regardless of what happens down here, okay, regardless of how long this takes, we know that this up here is an inefficiency. We know there is liquidity sitting there in the market. And again, in this case, because the price is here, this up here is buy side liquidity. Okay. So we're looking at this area up here. Now, it doesn't have to necessarily be for a buy order, because if you're looking for shorts here, you know that this area is fair game for a potential retest. Okay. So if we play it forward now, you can see where we drop a little bit lower, and this is where traders get themselves in trouble because they look at this here. Okay. And they're looking at this inefficiency and saying, I'm going to short this up here. Well, then guess what? The market moves lower. And what they tend to do is chase this lower into the lows. Now, that is the wrong move because we want to short high, obviously. Okay. And we know, again, that we have this pocket up here. Let's mark this off. So this entire area up here is going to be that buy side inefficiency. Okay. This is where, if you're looking to short on something like the daily chart, and again, you can use this on a 1 hour time frame, a 15-minute, the same concept applies. If you're looking for shorts here, this is where you want to do business. Okay. You want to do business up here because you want to short high, and you also want to see this area back here, okay, mitigated or retested before you short. Okay. So playing this forward now, you can see that this is where the market took some time. Okay. It took some time through here. However, knowing what we know now though, regardless of how long this takes, really, this is just consolidation down here, and the market is trapping shorts. They're trapping shorts here, okay, because you've got now liquidity building above these highs. And we also have liquidity back here from this move lower, okay? So you've got multiple factors now building up to where we know that the likely scenario is that the market comes up here, tags this area, takes out the liquidity above these recent highs during this consolidation, and then also, okay, mitigates this area back here and fills those orders that were not filled. Now, remember, you might be looking at this and thinking that there's no way that orders from back here from a month ago would still be there. But there will be a ton of orders still there, trust me. And another thing too, even if those orders were pulled, what often happens is those larger traders know that areas like this tend to be mitigated. And so what they'll do is over here, they'll start placing orders up here, right, to short the market, knowing that again, this area is likely to be mitigated. We also had, this is a separate topic, but I've made videos on this before. We also had a change of character down here, meaning the euro flipped bearish. Okay. And so even if these orders back here are pulled, a lot of those larger traders, a lot of those institutions will actually start to place their sell orders up here, knowing that's likely to be mitigated, knowing that we have flipped bearish. Okay. So what we get from the euro from here, and by the way, guys, this is not hindsight stuff. I've actually made videos on this specific setup for weeks. Okay. And what you'll notice is that we tapped into that area. We even swept the high right back here. But the point is that if you understand that there was liquidity up here, okay, that was left untouched, again, unfilled orders, then down here in this area, regardless of how long this took, and it did take a while, regardless of this right here, you knew that this was the likely place the market was trying to go. Remember, it's all about where is the market trying to go, and it's all about liquidity. It's all about this move back here, okay? So knowing this, right? Again, we're down here. We know the likely move is up here. Now, look what we formed on the way up, okay? And again, remember, the market ping-pongs back and forth. Remember that game Pong, right? With the ball bouncing back and forth between those paddles. So it's the same exact thing. The market bounces up here. We have this inefficiency back here. We have unfilled orders back here. The market bounces up. And then guess what happens? Look what happens down here. We have this displacement. Notice this candle right here. Notice this candle right here. These are inefficiencies in the market, and the same concept applies. Because the market moves so aggressively higher, we had limit orders building through here, okay? And a lot of those limit orders are still down here. Furthermore, look at these lows, right? You've got stops that build up below these lows, okay? So let's take a look at this here. and see what happens. All right, so we know that we've come into this pocket back here. All right, so I'm going to move this over. We knew that we mitigated this through here, and now we have a new area below this low. Okay, so now this is the new area where the market is likely to tap into. And again, we talked about this in real time, for weeks. Okay, and you can see here the market took its time, right? But it finally came back here into this region to fully mitigate or fully retest this area. And it's all about liquidity. Okay, there were resting orders back here that did not get filled, or at least fully filled on this way up because this was such an aggressive move. And that's exactly where we saw the euro tap into. It's the exact same concept back here, right? Limit orders on the way down that were not filled, liquidity here, the market seeks liquidity. Okay, and you will see this over and over again. This is not just about cherry picking this right here. This is just the recent price action from the euro, but you can see the same thing back here. Okay, the same exact thing happened where we got displacement up, a very aggressive move up. Okay, we had all of these inefficiencies down here, all these candles, we had limit orders that built. We had also this low here and this low here. Notice what happened. We had this low form, right? Stops built below this. We then took it out. We then had stops built below this. We took it out. Why did we do this? Why did we come back here into this area? And it all has to do with these inefficiencies that formed back here. Okay, because this back here represented unfilled orders. Okay, so another point that I want to talk about here is that don't get so wrapped up in the definition of a fair value gap. There's a lot of traders out there that dismiss fair value gaps, FVGs, because they think that they're just some magical thing that's supposed to happen, that's supposed to work, and they're not. Okay, a fair value gap, the term fair value gap was just created a few decades ago, but it actually was preceded by, in the 70s and 80s, 1970s and 80s, there's something called auction theory. Okay, and for those of you who are familiar with time price opportunity, TPO, you'll know like a single print in the market, that's auction theory. And that precedes, okay, by decades, the idea of a fair value gap. So this is a concept that has been around for over 50 years. Okay, so when you get a market that moves like this, don't get so caught up in, well, is this a fair value gap or not? Is this a fair value gap? The point here is that when you see a candle like this that is mostly untested, then that is going to be an inefficiency in the market, because I can guarantee you this candle right here, if we drop down to a lower time frame, there are going to be fair value gaps down here. Okay, and there's going to be, again, unfilled orders down here in this area following this very aggressive move up. Okay, so don't get so caught up in trying to find, the perfect order block, the perfect fair value gap, whatever it might be. Just think about it in terms of inefficiencies in the market, areas that are very thinly traded, because you can bet that there are going to be unfilled orders in that area, aka liquidity. And we know now that markets will ping pong back and forth between those. Okay, so when you're trading, here's the big takeaway. So in this case here with the euro, right, you can use these for both areas to enter the market and exit. Because if we know that a market tends to kind of ping pong back and forth between these, why not use areas, these pockets of inefficiencies, these pockets of liquidity as areas to both enter the market and exit? In other words, if you're looking at the euro back here and this is up here, okay, then you're looking for, if you're long here, you're looking to take profit up here in this region. Now, the same thing applies. Okay, knowing that we have, I'm going to remove these here just to kind of clean it up a little bit, but knowing that we have now on this move up, knowing that we have this inefficiency down here in this region. Okay, so let me put this back on the chart and I'm going to show you something on the 1 hour time frame. So knowing that we have this area back here, remember, don't get so caught up in fair value gap. Notice this candle right here. This is the candle that started it. In fact, it really started back here, but you can see that this candle right here, this low to this high, notice how this is mostly untested. We have this little tiny wick here, but mostly, for the most part, this is completely untested. So this is going to be an inefficiency, also liquidity down here in this area. So the point is inefficiency back here. Okay, the liquidity that built up along this area. Once the euro gets up here, you're looking for shorts. Okay, bottom line. You're looking for shorts because, again, we have the daily change of character down here. Okay, this was a bearish change of character. We've talked about this during the time, and you can see where we tap into this inefficiency back here. Now, let's go to this candle over here, and I'm going to show you something on the 1 hour time frame. And again, we talked about this at the time. We discussed this at length in Discord even. But what you'll notice here is that we had a 1 hour change of character. Okay, so we had the BOS, we had the BOS. I call these internal BOSs and internal change of characters. But once you had this right here, okay, it was time to look for shorts. Now, in terms of using liquidity for an entry and an exit, remember, this up here was the liquidity, those unfilled orders from back here on this very aggressive move lower. So on the one hand, we're using liquidity, what we know about liquidity, to look for entries, knowing the market's likely to tap into this area. And then we're also using it, okay, for a target. Now, the very obvious one here in this case would have been this right here, because notice on the 1 hour candle or the 1 hour time frame, notice this candle right here. Okay, this is a massive inefficiency for the euro. So again, we're using this to both enter the market and exit. So knowing that we have this change of character, guess what my target's going to be here, right? Yes, it can be these lows down here. However, it can also be quite a bit lower, knowing that all this down here is an inefficiency as well. Okay, and if we play this forward, let's go to something like a 4 hour time frame, just because it does take a little bit of time to get down here. But what you'll notice is that we do drop down. Now, it took some time to happen, and a lot of this is just because of the current events out there in the markets. But what you'll notice is that any shorts that were taken up here in this area on that change of character, would have played out nicely. And the same thing through here. There was even an internal change of character through here as well. But the point is that the target here in this case, the target here in both cases, was this area down here, because that was that inefficiency on the daily that we just looked at. Okay, so knowing that, again, market ping-pongs back and forth between these areas, they act as magnets, use them to both look for entries in the market and also exits. As far as how to confirm when to get in, though, I have made videos on that before. So be sure to check out the other videos on this channel and you'll find what you're looking for. Or again, check out the link in the description for the complete SMC training, where I walk you through exactly how I trade. And then the whole thing is going to make sense. You're going to have the idea of liquidity in the market, how it forms, how to find it, how to use it to your advantage. Then you're also going to have my exact strategy. And you put the two together, guys, and it's going to be a complete game changer for you. So that's it for today's video. I truly hope it helped. If it did, then subscribe to the channel and keep it locked in here for more videos just like this one. Also, check out the video right here where I walk you through my liquidity sweep pattern. It's something I've traded for years and works extremely well. So until next time, trade well out there and good luck trading liquidity.